What is going on, traders? Big week in the markets. Can't wait until the inflation data comes out. We are getting the CPI numbers, the consumer price index, on Wednesday, May 11th. What is going to happen? Well, if we take a look at UBS estimates, and UBS has been right on this every single month, and the times that they have been slightly off, they've actually overestimated inflation. So, per their estimates, they estimate that inflation actually peaked last month at 8.5% year over year, and that the CPI numbers coming out for tomorrow are actually going to show a drop off in inflation. Now, in my view, the markets are waiting for any bit of good news for relief. Why is that? Well, because we've had 5 straight weeks of negativity in the markets. So if you look at the NASDAQ, we've had 5 weeks of straight red, and this week is already starting off red. The last time we saw that was in the COVID crash of March 2020. The time before that, we didn't even see that in the correction of 2018, in the double dip correction of 2015. The last time we saw that, surprise, surprise, was in the financial crisis of 2008, which some deemed at the time more severe than the 1929 crash when adjusted for inflation. Needless to say, more than 5 weeks of red is not very common in the US stock market, certainly not in the NASDAQ index. Why am I bringing this up? I'm bringing this up to say that the market is looking for any sign of relief here. Now, I'm not calling this a bottom, although there are some indications that show we are closer to a bottom than a top. I will get into those for you, obviously, when we start getting into analysis. But the markets are looking for any sign of relief because if inflation data actually shows that we have already peaked and we are starting to trend down, then that means that one, the Fed's policies are going to, even if it's not true, they're going to give the facade that the Fed's policies are actually going to work. That means that you can surmise the Fed being less hawkish in future FOMC meetings, meaning raising the rates by lower than expected, right? Which the stock market actually likes. It'll give the impression that we can finally see light at the end of the tunnel as it relates to price instability, really the number one factor affecting the global and US economies at the moment. We have never seen a time period like this where you have unemployment at a record low and inflation at a 40-year high. Usually when inflation is high, if we take a look at the history of the Fed funds rate raises, you have to go back to the late 70s, early 80s when we had double-digit inflation, but the unemployment was severely high back then and the GDP was in negative range. We've never seen a period where we've had double-digit inflation, but the unemployment was historically low and GDP was actually doing fine. Although I will get to GDP in a second because we actually did officially record a negative GDP growth rate for the first time since the COVID crash of 2020. And if we get another one, that's going to indicate a recession. Now, I actually did buy some call options in anticipation of the CPI being released because the CPI is released before market open, 8:30 a.m. Eastern time. I could be wrong on that. This could totally fall flat on its face. And the exact opposite scenario could actually come true where if inflation is actually, if it comes in higher than the previous month, if we now are all of a sudden 9% or higher year over year, then you can actually expect the market to continue tanking. And I think that we will get to a bear market on the S&P 500 within the next 1 to 2 days if that happens. Right now, the S&P 500 is hovering at almost 16% down. We do have another 4% to go to officially hit a bear market on the S&P 500. And these would essentially be the highs from January 2021, taking us back over a year ago when these were the highs back then, right? So I can envision getting to this 3,800 level on the S&P 500 if the CPI numbers, and very quickly, by the way, if the CPI numbers come out as higher than last month or even higher than the projected 8%, because then it will seem like a helpless and defeated position that the Fed cannot do anything to control inflation and that they will have to keep on being even more aggressive and more hawkish on the FOMC meetings to come, that we will likely need to raise rates even more severely and sell assets off the balance sheet quicker than what was already projected or what was already stated in the last FOMC meeting. And that is going to scare the markets into more severe bear market territory. That is why every single day we wake up neutral and play these levels that we see on the indices, as well as some of these significant stocks that are seeing a lot of volume. We wake up every single day neutral. I don't care what happens. We have these levels drawn out pre-market. I send this out every single day. And if the stock falls below these levels, then I buy puts. If the stock goes above these levels, then I buy calls. If you want access to our day trading watch list, where we send this out every single day, link is in the description below. We also have a beginner section where you get to ask literally any question you like. We have coaches on hand ready to answer your questions. There is no question that is too stupid. Trust me. There are traders of all levels in our group, and I love that. So sign up if you want access. Would love to have you. You should be able to get around 30% off if you use the coupon in the description. All right, so if inflation is, as a matter of fact, trending down, are we close to a bottom? Well, I think in my view, if inflation is trending down, we are closer to a bottom than a top. So if we're already down 16, 17% on the S&P 500, are we going to fall another 16, 17%? Or could the next round of drops be incremental and we fall, say, another 4 or 5% before finding a bottom? I think the latter is the likeliest case. I don't think we are reaching 2008 levels, in my opinion, because we don't have a credit default risk that existed back in 2008. This is purely due to price instability and the inability to control inflation. While unemployment remains statistically low and GDP before this last reported negative GDP was actually historically strong. Also, if you take a look at investor sentiment, the more bearish we are, this usually is a good time to start buying, right? 53% bearish sentiment compared to 27%. And I've shared this before also, but if you just invest based off of the fear gauge, which we call the VIX, right? The VIX is the fear gauge based on S&P 500 options. You could see that if you invested when the VIX is between 30 and 50, that your gains are actually exponential versus if you only pick those times to invest versus if you invest when the VIX is in normal range and everyone feels hunky-dory about the markets. And if you look at the bull-bear spread that I just outlined by AAII, we are historically at a bottom for that metric. And this usually indicates that this is near a market bottom for the time being. One thing that I was pessimistic about, to be honest, was the last round of earnings. So if you look at the earnings, I've talked about this before, but really the major companies in the main indices like the NASDAQ or the S&P 500, most of the earnings were not great. Some were muted. Some, like Amazon, came in horribly, more horrible than expected. Tesla actually killed earnings, and then Microsoft and Apple came in line with what was expected. So we actually did not have, and we're only talking about the large mega cap companies in the indices. We're not even talking about the banks, which didn't come in with great earnings either. Same with the major healthcare stocks. Really, energy is the main winner so far of 2022. And at the end of the day, all the stock market wants to see are good earnings. Really, that's all the stock market wants to see. So the next earnings season is in the summertime. So if we get a combination of declining inflation and the next round of earnings are good, then I would be more optimistic about the future of the stock market, about the short-term future of the stock market. I took this fractal here from 2018, the last time that we had an aggressive rate hike cycle. And I can easily see this play out, especially if the inflation picture is not as rosy, right? I can see the S&P 500 go into bear market territory. And this will take us to the summertime when we have the next round of earnings. And if the next round of earnings are better than expected, because obviously there was lowered guidance from the previous earnings, so now expectations are lower, meaning they are easier to beat, then I could see an effect where, we would be near a bottom around the summertime. Don't take my word for it. This is all just analysis. I obviously don't know what is really going to happen with inflation. If I did, then we would all be rich. So this scenario is very dependent on some of these factors playing out. And you can see here so far that speculators are betting almost 90% that the Fed will only be doing around a 50 basis point rate hike for the next FOMC meeting on June 15th. Now, again, I think this is all dependent on inflation. If inflation comes in higher than 8.5%, then I think the Fed will be forced to get more aggressive, and you will start to see talks about a 75 basis point rate hike. Anyway, traders, so a summary is look out for the CPI inflation data. We will be live streaming it here, so tune in for the live stream here. We will be doing that around market open on Wednesday, May 11th. Keep your eyes and ears open for that CPI data. If CPI comes in 9% or higher, I do think that we see a violent reaction to the downside in the stock market. If CPI comes in better, 8% or less, then I do think that is an impetus for a short-term rally. And I do think that we'd be closer to a bottom than a top. Doesn't mean we can't drop more. I just think that the drop will be incremental compared to the drop that we already experienced, at least until the next earnings season, when the market will put these companies to the test again and tell them to show and prove. And if companies, especially if the mega cap companies, report negative earnings once again, then we will likely see more downside until the fall, until maybe the midterm elections are out. A lot of moving pieces. I know it's a lot to cover. Sorry if I confused any of you. Leave any questions that you have in the comment section below. I only aim to bring you first-class content as it relates to the markets. Sign up if you want access to all of our trades. Link is in the description below. We'd love to have you. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.